Welcome back to the deep dive. Our mission today is to really dig into the latest results from one of the world's largest retailers. We're looking at their Q3 fiscal year 2026, which wrapped up on October 31st.
Right, and our job is to cut through all the accounting noise, because if you just read the headlines for this quarter, you'd be pretty confused.
Totally. The numbers look great, but then some of the profit figures look messy, even negative.
Exactly. But the real story here, the fundamental takeaway, is about a company that's making huge strategic investments. And those investments are driving growth, but, they're temporarily hiding some of those gains behind some unique charges.
So let's start with the top line, which is, it's just unequivocally strong.
Oh, absolutely. Total revenue for the quarter hit a massive $179.5 billion.
That's up 5.8% year over year. And if you adjust for currency, it's even a little better.
It is. In constant currency, or CC, that growth is actually 6%. So demand is clearly not an issue.
And the digital momentum is it's impossible to ignore. Global e-commerce was up a staggering 27%.
And that's across the board.
Yeah.
Every segment saw that kind of acceleration. In this retail environment, that signals some serious operational health.
Okay, but this is where the paradox really kicks in, and we need to solve this for you right away. Despite all that growth, reported operating income for the quarter actually declined by 0.2%.
A decline.
Yet, when you look at the adjusted number in constant currency, it's up a very healthy 8%. So what is going on there? That 8-point swing is the whole story of Q3.
It really is the key. And that whole difference, that swing you mentioned, it's all because of a major one-time non-cash accounting event. It all comes down to PhonePe.
Right, their digital payments subsidiary over in India. They're getting ready for a potential IPO, an initial public offering.
Exactly. And in preparation for that, they had to record this huge $722 million non-cash, share-based compensation charge.
So just to be clear, that's not cash actually leaving the business.
Not at all. It's an accounting cost tied to the future value of that business. But it hits the international segment's income statement, and that immediately drags the whole company's reported number down.
So if we just, strip that one unique event out, what does the core performance actually look like?
The true core performance is that adjusted number, the $7.2 billion in adjusted operating income. And that's where you see the robust 8% growth. The actual retail operations are generating significantly more profit.
Okay, that clarifies the operating income. But the confusion, it kind of continues down to the bottom line with earnings per share, or EPS. The main GAAP EPS number was 77 cents.
Which is a massive 35% increase. Sounds fantastic, right?
It does, but you're telling me we need to be cautious there too.
We do, because that number got a big boost, about 20 cents a share, from a net gain on their equity investments. Think of partners like Symbotic, the automation company.
So volatile gains that aren't really related to selling groceries or electronics.
Exactly. So if we strip out those volatile investment gains, and we strip out that one-time PhonePe charge,
then what's the real profitability picture?
the real picture is the adjusted EPS. That came in at 62 cents, which is a very healthy 6.9% increase. So adjusted income up 8%, adjusted EPS up almost 7%. The core machine is running really well.
Got it. Okay, one last thing on the financials before we move on. Return on assets, ROA, went up, which is good, but return on investment, ROI, actually dipped slightly. Why would that be?
That dip is actually proof of the strategy we've been talking about.
How so?
ROI is getting hit because the denominator in that calculation, the invested capital, has grown so much. Management is just pouring money into property and equipment, CapEx.
Building up fulfillment centers, upgrading tech.
Precisely. They are sacrificing a little bit of short-term ROI for long-term capability. It's a strategic move, not a weakness.
And that spending takes us right to where we're seeing the results. That massive acceleration in e-commerce, global e-commerce up 27%.
It's fantastic. But what's even more fascinating is how they're turning into a monetization platform.
You mean advertising?
I mean advertising. Their global ad business grew 53% this quarter. That number does include their acquisition of Vizio, the smart TV company.
So that's about turning their reach into a full-on media platform, targeting customers on their TVs, not just in the app.
It is. But even if you take Vizio out of the equation, their core U.S. advertising engine, Walmart Connect, still grew by a stunning 33%.
And that's a huge deal for margins, right? Selling ads is much more profitable than selling produce.
Much more. And you see that same flywheel effect with customer loyalty. Membership income grew by 9% globally.
Powered by a 16.7% jump in actual membership fee income. People are signing up and sticking around.
That recurring revenue is gold. It helps protect margins, which, brings us to the gross profit rate. It was up, but only just barely, 2 basis points.
So why so little with all that high margin ad growth?
It's a classic balancing act. The U.S. business did really well on margins, but that was offset by some pressure in the international segment.
And that's a timing thing.
It's a timing thing. It's all about Flipkart's big billion days event. It boosted sales in Q3, but, those are promotional sales, so they weigh a little on the margin rate. We'll likely see that reverse in Q4.
Let's focus in on the U.S. then. Walmart U.S. saw net sales grow 5.1%.
And the core comparable sales, excluding fuel, grew 4.5%. That was a mix of more transactions and a higher average ticket.
So more people are coming in, and they're spending more when they do.
Right. But here's the most strategic part of the U.S. story. They saw market share gains across all income brackets.
And it was led by upper-income households. That's the key competitive point. They're pulling wealthier shoppers away from other stores.
And the question is why? I think it's a combination of value and increasingly convenience. Speed. You have to look at this one number. Expedited deliveries, so orders that get to your door in 3 hours or less, they grew 70% year over year.
70%. That is an incredible growth rate for a logistics operation of that scale.
It's extraordinary. And these super fast deliveries now make up about 35% of all their store-fulfilled orders. This is the CapEx we were talking about, paying off right here.
They're turning their stores into these incredibly efficient local fulfillment centers.
Exactly. And you see that same discipline in their inventory management. Inventory in the U.S. only grew 2.6%, which is about half the rate of their sales growth. That's just great execution.
Now, in terms of what people were buying, grocery and health and wellness were the big winners.
Right. Low single digits for grocery, low double digits for health and wellness. General merchandise was a little softer, which signals a cautious consumer.
People are prioritizing food and medicine over, say, new clothes or toys.
That's the story. Now, if we switch over to Sam's Club, the warehouse business.
Their comp sales were up 3.8%. Looks like they're focused more on volume, with transactions up and the average ticket slightly down.
The anchor there is always membership. And membership income was up a strong 7.1%.
And the tech adoption is impressive. Scan and Go app usage was up 450 basis points.
That's a huge efficiency driver for them. And their e-commerce growth was right in line with the rest of the company, up 22%.
Okay, let's go global. The international segment was really the sales growth leader, up 11.4% in constant currency.
A huge quarter for them, hitting $33.7 billion in sales. The growth was really led by Flipkart in India, China, and Walmex.
But again, we have to remember the Flipkart timing. That big sales event boosted Q3, which means we should expect a tougher comparison for them in Q4.
That's the trade-off. But looking at the other markets, Walmex, so Mexico and Central America, grew over 5%. Canada also grew over 5% with really strong e-commerce.
But the real story internationally, it has to be China.
Without a doubt. Net sales in constant currency grew almost 22% there. And even more importantly, e-commerce grew 32%.
Which means their digital sales mix in China is now over 50% of total sales.
50%. Think about that. More than half their business in China is now digital. It's a true digital-first operation.
What does that tell you about their future model everywhere else?
It's the template. It shows that in a super competitive, fast-moving market, they can pivot and win. It proves the model of integrated, fast delivery, and in-app, everything works at scale.
All right, so let's bring it home with capital allocation and their updated outlook for the rest of the year. The cash flow looks incredibly strong.
It really is. Year-to-date operating cash flow is up $4.5 billion. Free cash flow is up $2.6 billion.
And that cash flow is what lets them return money to shareholders, nearly $1 billion in buybacks this quarter, while still funding all this investment.
Yep, and you see that investment reflected in the CapEx, which increased by almost $2 billion year-to-date.
So this all leads to them raising their guidance for the full fiscal year. What does that signal to you?
It's a huge signal of confidence. Management is telling you that this acceleration they're seeing is real and sustainable. They've raised their outlook for net sales growth.
But more importantly, they also raised the outlook for adjusted operating income.
That's the big one. Raising operating income guidance means they expect their efficiency efforts to really pay off. They're seeing better operational leverage than they planned for.
And they lifted the adjusted EPS guidance, too, even with a small currency headwind.
Right. And they signaled they aren't done investing, raising the CapEx guidance to about 3.5% of net sales for the year.
So, if we have to synthesize this entire kind of complex story, what is the single most important message for you, the listener, to take away from this quarter?
I think the message is that they are in this powerful, very deliberate strategic cycle. They are investing aggressively to win the future of retail, which is all about digital delivery and advertising.
And the core business, the underlying machine, is running incredibly well, as you can see from that 8% jump in adjusted operating income.
Exactly. Even while the headline numbers get messy because of necessary things like that phone P accounting charge.
The aha moment for me is just how they're redefining what it means to be dominant in retail. That 70% growth in expedited delivery.
It's incredible.
And combining that with their success in capturing those upper income shoppers, it just shows that convenience and speed are now every bit as important as price.
And if you connect that to the bigger picture, you have this massive growth in high-margin advertising. You have the Vizio acquisition to build out a media platform. And you have proof from China that a 50% digital model can work.
So that really raises an important, maybe provocative question for you to think about.
Yeah.
How soon will we start viewing this company less as a global chain of stores and more as an international digital advertising and logistics platform?
Because when you look at these numbers, the profits are increasingly flowing from speed and media, not just from shelf space.